Welcome back, financial thrill seekers, to another electrifying episode of the Maverick Podcast, the show that's as daring and unpredictable as the markets themselves. I'm your host, Alex Reed, your guide through today's financial roller coaster. Buckle up, because today we've got a twist that even Hollywood couldn't script. Wall Street's smartest algorithms have just flipped bearish for the first time since January 2023. Here's the scoop. Fresh out of Bank of America's sizzling hot systematic flows monitor, the financial world's equivalent of reading tea leaves, only way cooler and more precise. Just 17 trading days ago, the bulls were celebrating new all-time highs for the S&P 500 and NASDAQ 100. Champagne corks popping, spirits soaring. But what a difference a few weeks make. Fast forward to today, and we've seen 4 straight weeks of market declines. And now, here's the kicker. Those legendary trend-following traders, better known as CTAs, commodity trading advisors, have officially flipped the switch to short. Yes, you heard me. Short positions on both the S&P 500 and NASDAQ 100. If you're wondering, is this significant? Consider this. CTAs aren't your average traders. They're the algorithmic titans that manage billions and thrive by surfing market trends. According to BofA's systematic model, powered by a potent cocktail of short-term and long-term price signals, these quant kings are now aggressively betting against the American giants. Let me break down the numbers, because you know we love precise stats. S&P 500. CTAs have shifted to a minus 12% short position, with bearish scenarios predicting this could deepen to minus 54% in just 5 trading days. NASDAQ 100. Not far behind, now at a minus 10% short, potentially plunging to a chilling minus 53% if the market continues south. Russell 2000 small caps, already bleeding heavily with a whopping minus 72% short stance. But wait, there's more intrigue brewing overseas. The Euro Stoxx 50, Europe's blue chip index, is still riding a precarious bullish wave at plus 73%. However, even that optimism is fading quickly, with potential sell-offs looming at just a 2.3% decline. And it's not just equities. Let's talk bonds for a second. The German Bund, driven higher by Berlin's imminent defense spending spree, has CTAs also ramping up their shorts. On the other side of the pond, U.S. Treasury yields ticked upward, but the model sees potential for CTAs flipping long if those yields decide to back down. Now, currency traders, listen up. The U.S. dollar's looking weaker than a wet paper towel, down 5 of the last 6 weeks, which has CTAs turning bullish on the British pound and the Japanese yen, betting big on continued dollar decline. Commodity traders haven't missed the party either. Gold hit a dazzling new high, with CTAs riding stretched long positions all the way to the vaults, while oil prices are heading into bearish territory. And here's an especially juicy detail. Leveraged and inverse ETFs, those high-octane funds loved by risk-takers, now account for roughly $736 million of S&P 500 moves and a staggering $1.6 billion in NASDAQ swings every time the market ticks up or down just 1%. Yes, folks, volatility has a new best friend. Wrapping it up, the takeaway from today's financial drama is clear. Algorithmic traders are signaling caution loud and clear. And whether you're a bull, a bear, or just here for the thrill, now's a fascinating time to be watching those charts closely. Thanks for tuning in to another wild ride on the Maverick Podcast. Until next time, keep your trades sharp and your strategies sharper.